Hey, what's up, guys? Welcome back to the channel. My name is Frank Mularcik, and welcome to episode 18 of my Dow Analysis series. In this video, we'll be analyzing the 13th largest company in the Dow by market cap, and that is McDonald's, ticker symbol MCD. They were actually the 14th largest company behind Verizon, but recently McDonald's has gone up just a little bit and Verizon has been going down on their earnings. So they actually surpassed Verizon in market cap. So I apologize that the video is a little bit out of order. I planned on making this video, before those events happened, and at that point, McDonald's was the 14th largest company. But I hope you do enjoy it regardless. So first of all, just taking a look at their business, I'm sure most of you know what McDonald's is, but if you don't, they are a restaurant company that franchises and operates fast food restaurants that serve locally relevant foods in 119 countries. And at the end of 2021, there were 40,031 McDonald's locations worldwide, with 37,295 of those restaurants being franchised, which is about 93%. And they have three main business segments at this point, which are just the USA, and then the next segment is international operated markets, and then the third segment is international developmental licensed markets. It gets a little bit confusing, but the international operated markets is centered in Canada, Australia, and major European countries, and these are countries that they have lots of McDonald's locations in. And then the international developmental licensed markets are located throughout the rest of the world, smaller countries in Europe, South America, Africa, Asia, of course. So this segment kind of deals with lots of countries that there's smaller amounts of locations, and in this segment alone, there's over 80 countries doing business, which is pretty exciting. So McDonald's does operate under a franchise model, but their franchises actually fall under one of two distinct categories. So the first of those is a conventional franchise, and in this category, McDonald's basically owns or leases the land and building for the restaurant, and then the franchisee pays for, other upfront costs like equipment, signs, seating, stuff like that. And then basically, the franchisee is responsible for operating the business, and they pay McDonald's, first of all, in some sort of upfront fee in order to use the brand. And then they also pay McDonald's rent on a regular basis and royalties on a percentage of their sales. And in this case, McDonald's also sometimes co-invests with the franchisee to fund improvements to the restaurant, which can ultimately, help McDonald's, the company, and the franchisee. Now, the second model of franchise is called a developmental license or affiliate. And basically, in this case, the entity or person or business owner basically just licenses the McDonald's brand and use of their products. So in this case, the licensee is responsible for the land, the building, all those upfront costs, and operating the business. So McDonald's in this case usually doesn't invest any capital in these types of businesses. They just get that upfront fee for the brand and the menu per se, and then they also get royalties on a regular basis as a percentage of sales. So like I said, in both cases, McDonald's gets royalties, which is awesome, on a percentage of sales, and they also get those initial fees for licensing the brand. And then in the case of the conventional franchise, they get rent as well. So that's awesome that they have those different revenue streams, and they actually own and operate about 2,700 restaurants themselves that aren't franchised. And this actually makes McDonald's a very credible franchisor because it allows expertise from the company operated restaurants to trickle down into the franchises. And then if the franchises have some idea, they can test it out within their individual stores or restaurants, and if that works, then they can communicate that and expand that into other franchises around the world or into McDonald's owned restaurants, which is really super powerful because it allows for kind of trial and error and increased efficiencies and sales ultimately, which will benefit both the franchises and the McDonald's business. So as we'll talk about later, McDonald's revenues have really been declining a bit over the past 10 years or so. And so they have a new strategy that they announced at the end of 2020, which is called Accelerating the Arches. And it's just supposed to provide a more focused pathway for the business to grow. And it basically has three pillars, which are M, C, and D. So the M stands for maximize marketing, which is focused on new and culturally relevant approaches to marketing. And that's also going to highlight, they want to highlight the value and affordability at every tier of the menu, because obviously McDonald's is known as being cheap and affordable. So I want to highlight that. And then the C stands for commit to the core, which basically means tapping into demand for, familiar products such as burgers, chicken, and coffee. Recently, they've been doubling down on, the crispy chicken sandwich craze, I guess. So they have a regular crispy chicken sandwich and what they call the McSpicy, which I think is kind of funny, all those dumb names, but, it sticks and it creates, brand awareness, brand recognition, which is definitely good. And then the D stands for double down on the 3Ds. So they break that down into 3Ds. The first one being digital. So they have, rewards and loyalty programs. And then they're, expanding access to mobile orders and kiosk orders, which just makes it easier, I guess, for customers to order the food. And, the rollout of the loyalty program is actually still underway in a lot of countries, but so far it's been really successful in the US. Which is good to see. The second D stands for delivery, and right now about 80% of restaurants do offer delivery, and they're trying to expand that number for sure. And in 2021, they actually entered into long-term partnerships with Uber Eats and DoorDash, which will hopefully benefit both parties there. And the third D is for drive-through. So right now, about 25,000 locations, which is around 75% of the business, has drive-through options. And most new restaurants are going to include a drive-through, so that number is just going to increase, which is really going to allow for greater customer flexibility and choice, and hopefully allow customers to purchase more products ultimately. So I really like their strong foundation to their business, with their strong brand and real estate business, I guess. But I also like that they have a strategy and they're executing on that strategy to continue growth into the future. And next, looking at earnings, just a few days ago, they announced their second quarter 2022 results, and we're going to talk about that a little bit. So the first number they talk about is global comparable sales, and it gets a little bit confusing because sales is, the amount of sales that all McDonald's restaurants, produced, I guess. Whereas, all of those sales don't come in as revenue for the McDonald's business because a lot of those are franchises and they only get a percentage of those sales. So global comparable sales increased 9.7%. And this is just looking at, the change in sales from a set of restaurants that have been operating for more than 13 months, which is, the same set of restaurants. Just looking at that from last year to this year, those sales increased 9.7%. And this does include restaurants in Ukraine that are temporarily closed, but it does not include restaurants in Russia because those have been deemed permanently closed. And total system-wide sales increased 4%, and that, does include those any businesses that have not been open for more than 13 months and, any restaurants that have been closed as well. So it shows that, the Russian business, the closure of that Russian business did have a sizable impact on the company, but most of that impact just came in this quarter. And so that likely won't continue into the future. And when we look at revenues for McDonald's, as opposed to sales, revenues were actually down 3% to $5.7 billion. Net income for the quarter decreased a whole 46% year over year to $1.2 billion. But the main driver of this decrease was a $1.2 billion expense, which was related to the sale of the business in Russia. And this accounted for around 90 cents per share of impact when it comes to the earnings per share. So the GAAP earnings per share was $1.60, but when you take into account that 90 cents earnings per share impact from the Russian sale of the business, and then there was also a 5 cents per share expense related to the settlement of a tax audit in France. So when you take those two values into the account, you get to an adjusted earnings per share of $2.55, which is an increase of 8% year over year. So overall, earnings really weren't that good for the second quarter, but it's kind of clear that this decline is probably an anomaly and something the company can hopefully rebound from quickly. So I think it'll definitely be interesting to see, what the earnings look like in Q3, because hopefully the main effects of the sale of this Russian business was all in Q2 and is not going to affect them much going forward. And next we are looking at the balance sheets. As you can see here, this is actually from March 31st of 2022. For some reason, they don't, publish the balance sheet at the same time for the quarter that they publish the earnings. So they didn't have the second quarter balance sheet available yet, but that's all right. It's really only a few months old. We can see current assets are actually down substantially to $4.7 billion, mainly due to a decrease in cash, which, as I've said before, is what a lot of companies are doing at this point. So for me, that's expected. Current liabilities are up just a bit to $4.2 billion, which gives them a current ratio of a little bit above 1. And that basically means they have enough liquid assets to cover all of their liabilities within the next year, which is definitely a good thing. When we look at total assets, they are down as well to around $50.9 billion. And total liabilities are $56.9 billion, which actually means that shareholder equity is negative. On first glance, this looks like a bad thing, but there's a few explanations for why this isn't really that big of a deal. So the first explanation is that McDonald's has been very aggressive with share buybacks. So this is a chart of the share buybacks, or sorry, outstanding shares since 2010. And in 2010, they had around 1.1 billion shares, and now they only have 742 million. So that's about a 33% reduction over a 12-year period, which is really great to see. And if they hadn't, put that cash towards share buybacks, that cash would probably be somewhere on the balance sheet. At least some part of it would be, and that would probably most likely make shareholders' equity positive. Another thing to take into consideration is that they do, because of the nature of their business, like I said before, they do have a lot of property such as real estate and equipment. And if we look here at the balance sheet, it says that that is valued at cost. And it's very likely that a lot of that is worth a lot more today than it was when they bought it, which would make their assets number a lot larger and give them positive shareholder equity. So I really don't think that issue is that big of a deal. When we look at debt, their long-term debt here is $34 billion, which when we take into consideration their cash position, that gives them net debt of around $31 billion. In this case, because of that negative equity, it doesn't really make much sense to look at the debt to equity ratio. But I think, the debt is on the higher side, and it could hurt them a bit as interest rates keep going up. So overall, I think the balance sheet is in a fairly decent position, but I would not call it great or outstanding. On the one hand, I think it does understate the value of their real estate portfolio and brand, but they do have a lot of debt, which I think could be concerning over the next few years. So when we look at the dividends for McDonald's, they have a yield right now of around 2%. Which for some people is on the low side, but that really isn't a problem at all for me. I think that's, a perfectly acceptable dividend yield for where I am in my investing career. And another thing I do like is the payout ratio is pretty healthy at 55%. And that means they have plenty of cash left over to continue expanding their business after they pay the dividends. And when we look at the rate at which they are growing their dividends, they have been growing them at about 8% over the last 5 years, which is right around the target for my portfolio. When we look at the past year or two, the dividend increases haven't been quite at that 8% level, more like 6 to 7%. But that's not really that big of a deal if that's just a short-term thing. As long as they can, stay in that 7 to 10% range, that would make me really happy and attracted to McDonald's for sure. We can also expect to see a dividend increase announcement from McDonald's towards the end of September. So I will be excited to see how much they increase the dividend by. If it was in the range of, 8 to 10%, that would be super awesome. And when we look at their history of growing the dividend, they have been growing the dividend for 46 years, which makes them a dividend aristocrat, and it makes them very close to becoming a dividend king, which I am pretty sure they will probably reach in 4 years, which will be very exciting to see. Overall, I think the dividend is strong, safe, and growing, which are all positive signs in my book. So when we start to look at valuation, we can see right here that the PE ratio is currently around 27 right now, and that's definitely above historical averages of around 20. So that could be a little bit concerning right now. We can see, the PE ratio has gone up pretty quickly the past year. And the reason really for that is because of earnings. Like we've discussed, the earnings recently have not been quite as great because of some, short-term issues. And if we look at earnings per share over time, that kind of illustrates that fact. So generally, the earnings have been growing fairly well, but recently they've had that decline, which affects the PE ratio. But hopefully, I think those earnings will rebound pretty soon, and the PE ratio will come down to more reasonable levels, I think. When we compare them to the sector, McDonald's is in the consumer discretionary or consumer cyclical sector. It definitely looks a bit overvalued, I would say. So the consumer discretionary sector has an average PE ratio of 12, which is way below McDonald's 27. But if we compare them on a more fine level of comparison to the restaurants industry, they actually look pretty decent. The restaurants industry has an average of 28 right now, which is similar to McDonald's PE ratio. So, you could argue that compared to their peers, they're, fairly valued, but you could also argue that maybe the restaurants industry as a whole is just more overvalued right now. And so maybe we just want to stay away from that industry in general at this point until it comes down to a more reasonable level. I think both perspectives are fair at this point. The next method of valuation I use is a discounted cash flow model. And for that calculation, I got a fair value for McDonald's stock of $132, which is really below the current price of around $260. When we put a 10% margin of safety on that, that gives us a buy price of $119, which again is less than half of the current price of $260. I tried to look at a few other discounted cash flow calculations for McDonald's from some analysts that I saw online, and there was a few differences I noticed. So first of all, they expected a lot faster revenue growth than I was predicting. I was predicting in the range of 3% per year. They were predicting more like 5% per year. And they were also expecting higher margins than I used. I used around 28%, I believe, and they had, 31, 32, 33% margins. So maybe their assumptions are more accurate. I'm really not sure. But something I found interesting is that there's a lot of analysts that are expecting a revenue decline in 2022 overall compared to 2021. So I'm not sure if the revenue growth rate of 5% really makes that much sense over the next few years. And looking at a chart as well right here, the first thing that I see is that they have a lot of volume in the $250 range. This is a 1-year chart, by the way. And their 200-day moving average is also around $250, which is a good sign that both of those different indicators kind of point to the same price. That 200-day moving average has also acted as support recently in the past few weeks. I really like that those two indicators are kind of pointing to the same thing. As we can see as well, they've really been consolidating since the beginning of the year. At the beginning of the year, they were a lot more volatile, and now it's kind of trying to consolidate a little bit. And it looks like over the past few weeks, or days, they've kind of been breaking out above that consolidation, and that breaking out is to the upside, which is really a positive sign for the stock for sure. We can look out a little bit further to the 3-year time frame, and at that time frame, there's some decent support around the $230 and $200 level. So I think from a technical perspective, the stock McDonald's actually looks fairly strong at this point, but I also don't think it would take a whole lot for them to break below $250 if we see some more pressure on the overall market. And in that case, I think they could fall to $230 fairly quickly, and maybe even below, which is where I would really be more interested in the stock. So one of the things as well that I do like about McDonald's is their strong brand and the fact that their products appeal to a lot of customers. So in 2021, they were ranked number 72 for brand loyalty of companies in the US. That doesn't seem all that great on the surface, but in 2020, just a year before, they weren't even in the top 100. So they really moved up rather quickly there. And I hope that their Accelerating the Arches program and strategy is working, and that shows, that program is working by drawing in, more loyal customers with their rewards programs. And the other thing I do like is the franchising model of their business, which does allow them to invest in a lot of real estate, and also, allow smaller business owners, I guess, to take advantage of their brand and business. One of the big concerns for McDonald's for sure is the decline in revenue, as I mentioned before. But if we look at it a little more graphically here, you can see that their revenue has grown a little bit over the past 10 years. Around 2010, 2011, it was growing some, but since then it has kind of decreased a lot in the past 7 years. And the growth from 2010 to 2022 is, minuscule. When we look at their net income, however, it has continued to grow, generally speaking. There has been some variation up and down, but they are in a cyclical sector, so that's a little bit expected. And the takeaway from that, I guess, that they are more making a thoughtful transition towards focusing on margins and net income rather than revenue. And so even though their revenue hasn't really grown, their net income and earnings have grown a fair bit. So I don't think the revenue decline is that big of a worry. For me, I do like the stock, but I think it is overvalued for sure, and I don't own it at this point in my dividend portfolio. I would say the main reason for that is just because I have a lot of consumer discretionary consumer cyclical companies. I don't think I have anything in the restaurants industry, so maybe that would be a nice diversification aspect to the portfolio, but really don't have any desire to add a consumer discretionary company at this point. So that's why I don't own it. But I have bought some for my brother in his dividend portfolio because of the strong business and the dividend and strong dividend growth. So right now his average cost is $216, which I'm pretty happy with. So like I said, I probably won't be adding to that position unless it's below 230. And definitely would like it closer to that average cost of 216. So let me know what you guys do think of McDonald's down in the comment section below. I love hearing from you, hearing your thoughts and opinions on different stocks. It's really fun just to read that and respond. And I also want to thank everyone for sticking around to the end of the video. I really do appreciate it, and I will see you all in the next one.